Hey everyone, and welcome. Today, we're going to tackle a huge part of the investment world that, let's be honest, often feels like a bit of a mystery bonds. We hear about them all the time, but what are they really? Well, stick around because we're going to pull back the curtain and figure this out together. Right? This is the big question. You always hear stocks and bonds, but for a lot of people, that second one is just a fuzzy concept. But here's the good news it's actually way, way simpler than you might think. Seriously. You do not need a fancy finance degree for this. The big secret is, a bond is just a loan. That's it. At its absolute core, when we talk about a bond, we're just talking about a loan. So let's look at the official definition for a second. Okay, so picture this. You've got two main players. On one side, you have a company or maybe even a whole government that needs cash for a big project, like a new factory or a public park. And on the other side, you have an investor. That could totally be you, who agrees to lend them that money. And in return for that loan, the company or government promises to pay you interest. So this is the key thing to remember. When you buy a bond, you are the lender. You're basically the bank. It's a pretty simple idea when you think about it that way. To really see how it all works, let's walk through a quick story. Let's make up a place called Fairview City. This little story is going to show us the entire life of a bond, from the very beginning to the very end, and it'll make everything we just talked about totally clear. So here's the deal. Fairview wants a big, shiny new stadium, but they don't have the cash on hand. What do? They issue bonds. Then an investor, let's say it's you again, buys one of those bonds. You've just loaned the city your money. Now, for the entire life of that loan, Fairview is going to pay you regular interest. And then, at the very end of the term, when the bond matures, the city gives you your original investment right back. All right, let's put some numbers to this. In our story, the bond you bought has what's called a face value of $1,000. This is the principal. It's the amount of money you loaned to Fairview City. And this is the bond's term or its maturity. Fairview has agreed that this whole arrangement will last for 10 years, so it's a 10-year loan. And this is the fun part, the coupon rate, which is just a fancy name for the interest rate. Fairview promised to pay you 2% interest on your $1,000 loan every year. So what does that mean in your pocket? It means you get $20 a year, every single year for 10 years. And there you have it. This is why bonds are so useful. It was a win-win. Fairview got the cash it needed to build that awesome stadium, and you, the investor, got a nice, predictable stream of income, and then you got all your money back at the end. Pretty cool. Okay, so now we get what a bond is. But how does it stack up against the other thing everyone talks about, stocks? Well, the huge difference between them really boils down to one simple word, predictability. Yeah, you can see the difference right here. With a bond, you know the deal up front. You know the interest you'll get, and you know when you'll get your original money back. It's a set schedule. But stocks? Profits and losses are all over the place, driven by the market, how the company is doing, so many things. It's just a lot harder to predict. And that's exactly why bonds are often seen as the more stable, steady part of an investment plan. But, and this is a big but, stable does not mean risk-free. No way. Just like any other investment, bonds have their own set of risks that you absolutely have to know about. Okay, so the first and maybe the most obvious risk is what we call default risk. This is basically the chance that the company or government you loaned money to, well, can't pay you back. They might go bankrupt, miss an interest payment, or in a worst-case scenario, not be able to return your original $1,000 when the bond matures. Now, not all bonds have the same level of risk. This is the classic risk versus reward trade-off. Really stable issuers, like the US government, for example, are considered super safe. So their default risk is low, but they also pay lower interest. On the flip side, corporate bonds can be riskier. So to convince you to lend them money, they have to offer a higher interest rate or yield to make it worth your while. So the other major risk we need to talk about is interest rate risk. This one can feel a little tricky, but it's so important. Let's just ask the question, what happens to the bond you already own if interest rates out in the rest of the world suddenly go up? Let's go back to our story. You're holding your Fairview City bond that pays 2%, but all of a sudden the economy changes, and new bonds just like yours are now being sold with a 4% interest rate. Whoa! All of a sudden, your 2% bond doesn't look so hot anymore, does it? I mean, why would anyone buy your bond that pays 2% when they could just go out and get a brand new one that pays 4%? Your bond just became less desirable. So, if you needed your money back right now, and wanted to sell your bond before its 10 years were up, you'd probably have to sell it for less than the $1,000 you paid for it. You'd have to offer it at a discount to make up for the fact that it pays less interest. That's interest rate risk in a nutshell. Okay, so we've talked about risks, and you might be thinking, why would I want these then? Well, they play a really specific and important role in building a smart investment strategy. Let's zoom out and look at the big picture. It really comes down to these key things. People own bonds to protect the money they already have, to create a steady, predictable income stream, and this one's huge, to diversify their portfolio. Bonds and stocks often act like a seesaw. When the stock market is going crazy and heading down, investors often run to the safety of bonds, which can help balance things out. Look, we've really just scratched the surface today. There are tons of different kinds of bonds and all sorts of strategies. But the single most important message is this: the best investment you can ever make is in your own knowledge. So now you've got the basics down. You know the what and the why of bonds. The foundation is there. The only question left is, where do you want to take your learning journey from here? Thanks so much for tuning in.